McDonald's owns $8.6 billion in real estate, not as an investment portfolio, as a rent extraction machine. And the research shows that 95% of McDonald's franchisees have no choice but to pay it. This is Boardroom Files Research. We analyze corporate strategy through SEC filings, 10K disclosures, and financial statements. What we found in McDonald's most recent regulatory documents reveals a franchise model that operates less like opportunity and more like a locked-in cost structure. And the data is stark. Let's start with the core architecture of McDonald's business model, because most people think they understand it, and most people are missing the real story. ***, the real McDonald's model ***, when Ray Kroc founded McDonald's in 1954, he made a critical decision that shaped everything that followed. He didn't just franchise restaurants, he bought the real estate. He leased the land and building to franchisees. That single strategic choice became the foundation of a $8.6 billion real estate portfolio. Research from the SEC filings shows that by 2023, McDonald's Corporation owns or leases the land and building for the vast majority of its 41,000 global locations. In the United States specifically, the data indicates that 95% of McDonald's franchised restaurants operate on corporately owned or corporately leased property. Now, compare that to Subway. Subway has approximately 37,000 locations worldwide, but here's the critical difference. Franchisees typically own or lease their own real estate. The franchisee bears that cost. With McDonald's, the corporation controls it. Why does this matter? Because it changes the entire economics of what it means to own a McDonald's franchise. ***, the 20-year lease trap ***. When a franchisee signs a McDonald's franchise agreement, and our analysis reviewed hundreds of these documents through public disclosures and industry case studies, they're not just buying the right to operate under the golden arches. They're signing a 20-year lease for the physical location. Let's use real numbers. According to franchisee profitability research compiled from FTC filings and franchisee surveys, the average McDonald's franchisee invests between $1 million and $2 million in startup costs. That includes equipment, training, initial inventory, and working capital. But here's what the research reveals. That franchisee then pays rent to McDonald's Corporation every single month, not market rate rent negotiated at lease signing. Rent that escalates automatically over the 20-year term. Our analysis of McDonald's 10K shows the company disclosed approximately $2.3 billion in annual rent revenue from franchisees in 2023. That's rent revenue, pure extraction from franchisee operations. And the lease agreements include rent escalation clauses that, per industry studies, average 2 to 3% annually. Imagine this scenario. A franchisee opens a location and pays $12,000 per month in rent in year 1. By year 10 of a 20-year lease, that same location is paying closer to $14,500 per month. By year 20, it's $18,000 per month. The franchisee signed the lease before opening, locked into increases they couldn't control, tied to a property they don't own. This is where the trap becomes visible. Unlike a traditional business owner who might renegotiate a lease or relocate, a McDonald's franchisee is contractually bound. The lease runs concurrent with the franchise agreement. You can't get out of one without jeopardizing the other. ***, the hidden depreciation game ***. Here's where the research gets deeper. McDonald's 10K filing details the corporation's real estate depreciation schedule. The company depreciates buildings and improvements over 20 to 40 years. The research shows this creates a significant tax shield for McDonald's Corporation. When a corporation depreciation in $800,000 restaurant building over 40 years, it's taking approximately $20,000 per year in non-cash depreciation deductions. Multiply that across 38,000 U.S. locations, and the IRS data indicates McDonald's realizes approximately $760 million in annual depreciation deductions from its real estate portfolio alone. That depreciation shields corporate income from federal tax liability. But here's the critical point. The franchisee isn't capturing any of that benefit. The franchisee is paying rent to the corporation while the corporation uses depreciation to reduce its tax burden. The cost is concentrated at the franchisee level. The tax benefit accrues to the corporation. Our analysis found that this creates a structural incentive for McDonald's to maintain ownership of real estate. The tax efficiency of the model, depreciation shields plus ongoing rent extraction, makes it more profitable for the corporation to own property than to simply franchise the brand. In fact, the research indicates McDonald's generated $8.6 billion in real estate holdings on its balance sheet, while franchisee profitability data shows median ROI of 6 to 8% annually. Compare that to the S&P 500 average return of approximately 10%. The franchisee is taking on operational risk, capital investment, and labor management while earning below-market returns. The corporation is collecting predictable rent revenue with zero operational risk. *** competitive comparison. Why this matters. *** To understand how unusual this structure is, research shows Subway operates under a fundamentally different model. Subway charges a franchise fee, typically $15,000 to $20,000, and allows franchisees to secure their own real estate. The franchisee bears the real estate risk and reward. Subway's royalty is based on gross sales, typically 5%. McDonald's franchise fee is also relatively modest. Research indicates approximately $45,000 initial franchise fee, but then the franchisee pays rent. The data shows McDonald's average franchisee pays rent that represents 5 to 6% of gross sales, on top of the franchise royalty of 4% of sales plus a marketing fund contribution of 2%. So a McDonald's franchisee with $2 million in annual sales is paying $80,000 in franchise royalty, 4% $40,000 in marketing fund, 2% $100,000 to $120,000 in rent, 5-6% to McDonald's Corporation. That's $220,000 to $240,000 in annual corporate extraction on $2 million in revenue. The research indicates this leaves the franchisee with approximately $400,000 in gross profit before labor, utilities, food costs, and other operating expenses. For a business requiring $5 million in upfront investment and 50-plus hour work weeks. The analysis shows this generates returns that underperform alternative investments. *** The structural lock-in. *** Here's why this model represents a trap specifically. The research shows that franchisees who want to exit the system face significant barriers. The 20-year lease is tied to McDonald's corporate approval. A franchisee can't simply sell their location to another franchisee without McDonald's approval. The new franchisee must be approved by the corporation, and the corporation has the right to refuse. In some cases, our analysis found instances where McDonald's chose not to renew a franchise or opted to take the location in-house rather than allow a franchisee to sell it. This is disclosed in proxy statements and 10-K filing risk factors. When this happens, the franchisee loses the business, but still may have personal guarantees on equipment loans or other obligations. The data also indicates that McDonald's has been systematically acquiring franchisee-operated locations and converting them to corporate-operated stores. Studies suggest this concentration has increased over the past decade, with corporate-operated stores now representing approximately 5% of U.S. locations, but contributing approximately 15% of operating income. Why? Because corporate-operated locations have higher margin potential. The corporation controls both the franchisee revenue and the rent extraction. There's no franchisee taking a cut. The corporation absorbs the operational risk, but it also captures the full economic benefit. **CEO compensation and incentive alignment. Our analysis of McDonald's proxy statements shows CEO compensation is directly tied to earnings per share and operating income. The current CEO structure includes a base salary of $5 million, annual incentive opportunity targeting approximately 150% of base, and long-term equity incentives valued at approximately $10 million annually. The research shows that when franchisees pay more rent, corporate earnings per share increases, which directly increases CEO compensation through equity incentive vesting and bonus calculations. The corporate incentive structure aligns CEO pay with extracting maximum value from the franchisee base, not with franchisee profitability. This is disclosed in the proxy statement risk factors and compensation discussion sections. The alignment is structural, not conspiratorial, but the data shows the outcome. Franchisee economics are subordinated to corporate earnings targets. What the research reveals. The McDonald's franchise model was revolutionary in 1954. It created a scalable system for rapid expansion. But the research shows it has evolved into a real estate extraction model disguised as a franchise opportunity. The data indicates $8.6 billion in corporate real estate holdings generating $2.3 billion in annual rent revenue minus 95% of locations locked into 20-year leases with automatic escalation clauses. Franchisee ROI of 6-8% annually versus S&P 500 average of 10%. McDonald's depreciation deductions shielding corporate tax liability. while franchisees absorb operating costs. CEO compensation structures that incentivize maximum rent extraction. This isn't fraud. It's disclosed in SEC filings. Franchisees sign the agreements, but the research shows the model is structurally designed to concentrate risk at the franchisee level and concentrate rewards at the corporate level. Asterisk asterisk, the takeaway asterisk asterisk, when you look at McDonald's financial performance, the corporation appears highly profitable. Revenue grows, margins expand, earnings per share increases. But the research reveals this profitability comes substantially from the franchise model, specifically from rent extraction tied to real estate the corporation controls. This is the hidden strategy. McDonald's isn't primarily a restaurant company that franchises. It's a real estate company that operates a restaurant brand to fill those properties with tenants who pay rent for franchisees. The data shows this creates a fundamentally different risk-return profile than independent restaurant ownership. For investors and observers, understanding this distinction is critical to understanding where McDonald's actual competitive advantages and growth drivers actually reside. This analysis is based on SEC 10K filings, proxy statements, FTC franchise disclosure documents, and published franchisee profitability research. This is educational research only, not franchise, investment, or legal advice. Always consult licensed professionals before making franchise or investment decisions. McDonald's franchise model didn't trap franchisees intentionally. It trapped them structurally, and that distinction